Hey guys, welcome back. Now, today is a very special video, as I'll be talking to Lyn Alden of Lyn Alden Investment Strategy. Lyn is one of the top investment analysts right now and was also a keynote speaker at the Bitcoin event in Miami this year. And we got to talk about some excellent topics, like a summary of the key points of 2021, inflation and where it's headed next year, asset allocation, all things crypto, and will we get a cycle top and crypto winter next year, and also how likely it was that we'll get a big crash in the financial markets in 2022 as well. As always, if you do enjoy anything in the video, then drop a like, always appreciated. Okay, so let's jump in with Lyn Alden. Lyn Alden of Lyn Alden Investment Strategy, welcome.
Thanks for having me on, and I'm happy to talk about the subjects we're going to cover.
Brilliant. Well, I'm actually really excited because I get to pick your brains on all things investing over the next hour or so. So let's start with 2021, as it feels like a bit of a crazy year. We've had more money printing than any time in history. We've had a pandemic. So how would you summarize 2021 for investors?
Well, I would say you have to kind of take 2020 and 2021 together. And so obviously, we went into the pandemic era, and then because of the lockdowns and things like that, there were these obviously massive fiscal programs, and so expanded, especially in the United States, but also many other countries. We expanded the money supply at a much more rapid pace than any time, pretty much going back to the 40s. You'd have to go back to like the 1940s to find a similar rate of broad money supply expansion, which is different than just bank reserves going up, and so that inevitably causes, some inflationary pressures, especially when you run into some of the physical constraints. So it could be commodities, could be infrastructure, supply chains, manufacturing capacity, grid connectivity, things like that. And so, 2020 was kind of that huge bounce back year, and then 2021 is kind of those effects rippling into the year, and so kind of going downstream. Basically, we reinflated demand to super high levels. But we didn't necessarily reinflate supply to cover those. And we've also had a big rotation in the types of things we buy. And so we many of us cut that on our services, and then we instead set money towards more goods, durable goods, things like that. We remodeled our home instead of going on a vacation, for example. Or we consumed more things at home rather than going out to restaurants at quite the same pace we were. And so because there's that huge shift in demand, those other industries were not necessarily ready for that large of a demand shift. And so you ran into all sorts of supply chain issues. And so obviously this was a notable year for inflation, and also very good for most risk assets, broad equity indices, especially the United States, because when you have very, very high inflation, but you have super low interest rates, we have the widest gap, again, go back to the 40s pretty much, between interest rates and inflation in many countries. And that's a very good environment for risk assets, those deeply negative real yields, because cash is getting rapidly devalued, and so money shifts into those other assets. And of course, the risk happens when that bottoms out, and if some of that fiscal and monetary stimulus starts to subside, it can pressure risk assets. We can get to later, but basically 2021 was a story of that massive expansion without that corresponding kind of tightness in monetary conditions.
So that brings us nicely on to the big hot debate right now, and that is inflation. So US figures just came out, and they're now the highest in 40 years. So what do you think happens with inflation in 2022?
So I think it will stay elevated, but probably go down from these numbers. And so depends on what country you're covering. So I cover globally, but my focus is on the United States. And we've had, among the developed world, some of the largest inflation prints because we expanded our money supply more rapidly than most other countries did in 2020, 2021. And my overall base case is that somewhere either in quarter four, which we're in now, or quarter one of next year, we'll probably see the top of the headline CPI prints, and then we probably will cool off for a period of time. That doesn't mean that we go negative, doesn't mean we go back to normal, but I think some of those issues could begin to subside. We're already seeing, for example, that real estate is kind of topping out, and and there's a big component of CPI that is tied to real estate, and that's following that with a lag. And so when that kind of gets topped out, that could cause kind of a cooling off of that headline in CPI at least. In addition, we have money supply not growing as quickly as it did, say the peak of the rate last year. In addition, a big component was used car prices going up dramatically because we've had semiconductor shortages, and so we see signs that there's a lot of inventory for cars at manufacturers, and of course they just haven't gotten to the dealerships yet because they're waiting on those semiconductors. So whenever that semiconductor issue gets resolved, which is this sign, it's going to take a few years, that should be a disinflationary burst for the used car and the new car segment, right? Because you basically have a lot of that kind of stored up inventory coming to market. And so I do think we're going to see gyrations in inflation, kind of like how we already saw a gigantic lumber spike and then that cooled off and then it kind of rose again, while other areas of inflation, mainly the real estate segment, started kind of steadily going up. I think we're going to see rotations like that. But overall, I think that especially with fiscal policy pulling back and monetary policy tightening, I do think that we can start to see a cooling off of headline CPI. Now, Europe is a little bit different because Europe has these energy shortages, which are rather spectacular, and so when they get past those, right? So when you get past the winter months, for example, you start to see kind of again CPI kind of cooling off, maybe with a bit of a lag compared to the United States because their inflation started a little bit later and might end a little bit later. But overall, that's kind of a wild card because those grid and natural gas issues are so unique.
So let's say inflation stays around about the 7% mark. What are investors to do with their cash? So we've got billionaire investors like Ray Dalio saying cash is trash and it's actually one of the worst investments there is. But then I just crunched a portfolio of Warren Buffett and he's holding record amounts of cash equivalents in T-bills, where you're getting basically a little bit better than cash. And it's actually a third of his portfolio is now in cash equivalents. So who is right? Should we be hoarding cash just in case of a market crash? Or is cash trash for next year?
So again, Dalio, so when he talks about that, he's really talking long term. If anything, if you line up his cash is trash comments with market activity, they tend to be almost counter-cyclical. So, for example, he said cash is trash in like February 2020, which was like right before one of the most rapid crashes we've ever seen in risk assets, where cash would have been the best performing thing for the next quarter. And so you can have these periods where for a couple of quarters or a couple of years where cash is one of the better investments, right? So just because cash loses 5, 6, 7, 8% a year, you can have markets go down 10, 20, 30, 40% in a given year, compared to, depending on what market you're looking at. And so I think it's one of those things that depends on your risk tolerance and time frame. I think cash is going to be a very poor investment throughout the 2020s. I think the rates are going to stay persistently below the inflation rate for the majority of that decade. But there will be years where cash is probably towards the top of the pile in terms of investment performance, because you can have down years in equity markets and things like that. I don't know for sure if 2022 is going to be one of those, but I do think that 2022 is likely to be choppier and worse performing than the prior 2 years. Let's say for the S&P 500 and some of these other well-performing indices. I think that's where there's risk. I think with the fiscal pulling back and tightening monetary conditions, having some cash can make sense. In addition, it's important to know that Berkshire Hathaway, his company, is primarily an insurance company. It's a conglomerate. They're in multiple businesses, but at the heart of it is they have some of the largest insurance operations in the world. And so if you look at most insurance balance sheets, they're almost entirely in bonds. So he has a more kind of higher volatility, riskier portfolio than the average insurance company. He's very equity overweight for his industry, which is, I think, an important caveat to keep in mind. He's not necessarily like his personal portfolio might not be 30% cash. It's different when you're running an insurance company. So he's rather, balanced, I'd say, overall. Now, he certainly could deploy capital, but I think his challenge is he's having trouble with some of the valuations out there.
And one of the most confusing things right now is what's happening with gold. So the gold market has got everything that it needs to flourish. It's had a crisis with the pandemic. We've had record money printing, inflation, yet in 10 years, gold has just gone sideways. So what is going on with gold?
Well, it depends on what part of that period you look at. For most of those 10 years, the problem was gold got so overvalued in 2011, 2012, compared to the broad money supply, compared to all sorts of things, that it went through a natural bear market. So it's one of those things, if you start the clock at, say, year 2000, gold outperformed the S&P 500 since then. But if you start the clock at 2011, 2012, during the peak of the bubble that was in, it's been a terrible performer. And so it really depends on timeframes. Now, if we zoom in on what happened in 2021, I think the big thing that likely impacted gold was the rise of Bitcoin and some of the other cryptos, because a lot of the money that would have otherwise flown into gold, basically people that want sound money, right? So Bitcoin's got that big Austrian economist sound money community. A lot of that capital, if Bitcoin ever existed, it would have flowed into gold. And before, Bitcoin was small enough that it didn't really interfere with gold. But now that Bitcoin reached roughly $1 trillion market cap, if you look at gold's market cap, it's often cited around 12 trillion. But if you just isolate the private investment portion of it, so you take out central bank gold, and then you take out jewelry gold and industrial gold, things like that, even though jewelry has a monetary component, especially in places like India, but let's say you factor that out. You look at actual just private investment gold bars, gold coins, gold ETFs, things like that, that's maybe 4 or 5 trillion. And so when you have the Bitcoin market getting up to $1 trillion and the broad crypto market getting up to 2 or 3 trillion, that starts to rival gold's market cap. So I would say basically gold ran into competition, and basically, the overall pie went up quite a bit, and just that gold's percentage of that pie shrunk. And so gold kind of just chopped along sideways for a year where you'd otherwise expect that to do pretty well.
Okay, so moving on to 2022, and let's talk about asset allocation. So investors have mainly got 7 major asset classes: stocks, bonds, property, cash, commodities, alternatives, and a lot of people on this channel are interested in crypto, so we'll get to crypto shortly. So would you mind sharing a rough asset allocation for next year? Should we start with stocks? What's your outlook for stocks, and how much are you roughly allocating for next year?
So I think different investors obviously have very different areas of expertise, very different risk tolerances. I tend to be equity heavy. The equity market tends to be where I feel most comfortable, that I've done the most research, that I like having a lot of my capital in. So I tend to always be equity heavy, and it really comes down to what areas of the equity market I think are attractive. And so, for example, in the past, say few months, we've had the healthcare sector not performing very well, and partly because there was impending legislation in the United States that could push down drug prices. So that obviously affects American drug makers, but also, a lot of the European and other large drug manufacturers, United States is their big lucrative market, because we pay more for the same drug than most other countries, kind of just how we've structured things. And so, if that were to passed, especially some of the more, so there's like a spectrum. Some of them are really kind of, sweeping changes. But of course, the ones that can actually possibly get through the Senate are watered down. And so as that's kind of gone through, it's become increasingly clear that if something gets through, it's not going to be transformative. And so I think a lot of those got really cheap, and they're actually pretty attractive here, especially because in a period where markets might not do as well, like 2022 compared to such a strong period in 2020 and 2021, healthcare tends to be a more defensive area. And then we combine that with the fact that valuations are attractive. I do like that quite a bit. I also think some of the consumer staples, some of the energy pipelines, basically some of the lower volatility dividend type plays might be a good place to be for 2022, at least for a part of a portfolio. So that's kind of an area that I'm inclined towards. I think, again, going back to cash, I think having some either inflation protected securities or short-term ones that are kind of, they can be used as like cash equivalents, or just outright cash or short-term bonds. I think having some of those is useful because you can rebalance that into any volatility that happens for assets you actually want to own. And again, all it takes is like, say, a negative 10% year for equity markets for cash to outperform, right? So it's not a super high bar, especially after such a a strong period. So I wouldn't be all in cash, but I also wouldn't have zero cash. And then really, property is obviously a more personal decision because it's not just an investment, it's also a lifestyle decision. And so that's, it's partially consumption, partially investment. Of course, people then have, they can have second, third, fourth properties. They can go into publicly traded types of properties. I think that is market dependent. So for example, I think in the United States, we still have many zip codes that are not very overvalued in terms of property. I think there are still attractive areas of buying property. Basically, in the United States, a lot of foreign capital comes into our equity market. So our equity market is more expensive than similar companies in other countries, which is not always the case. But in this particular period of time, the equity market is very expensive. Whereas our real estate is kind of the opposite. So Canadian real estate, Australian real estate, many countries in Europe, the real estate is elevated for a similar type of property compared to the United States, especially if you're looking outside of New York and some of the other major areas. I think a lot, standards kind of suburban American real estate, while it's not exactly undervalued, it's perhaps less overvalued than some of our equity assets are.
And how about crypto? Obviously, crypto has had an explosive year. Do you own crypto yourself?
Yeah, so I have a sizable Bitcoin position since I've had since April 2020. I also have small kind of experimental positions in some of the smart contract ones to kind of research the ecosystem, and I've done some stablecoin kind of saving in that, kind of exploring that ecosystem as well. And so my view overall is that 2022 is still a very unclear situation because in some ways 2021 was so explosive that I wouldn't be surprised to see 2022 be a big consolidation year for the space. On the other hand, we've already seen, like Bitcoin in particular, like we're lower now than we were in February 2021. We've already arguably had kind of a partial bear market, and we are seeing signs of that potentially bottoming out. It's unclear. You can have fake out. So for example, if you look at 2018, during that big bear market after the big 2017 run, Bitcoin was showing signs of bottoming out. But then you had that big macro risk off in Q4, where S&P 500 went down 20%, junk bond market froze. That was the whole thing was tied to the Fed. But then you had basically Bitcoin capitulated. It got cut in half. And that was kind of an epic low, right? So it kind of was a fake out. All the signs were suggesting bottom, and then it just blew down anyway, and it took longer to recover. So you could certainly have one of those, but I would say my base case is that I think the market's kind of stabilizing and probably ready to go higher, but maybe with less explosive force than we saw last year. I don't really have a strong conviction on the performance of it in any given year because it's so volatile and you can get so many curveballs. I think one of the challenges to look out for the broader space is U.S. regulation and perhaps European regulation as well. So in the United States, Gary Gensler and others are focusing heavily on stablecoin regulation, basically making sure that their collateral and their overall safety makes sense, as well as making sure securities laws are applied evenly. So a lot of crypto assets basically pass the Howey test and therefore meet the definition of a security. Now we know that some of them, so for example, Bitcoin does not pass the Howey test. It never raised capital. It's classified as a commodity type property. It's not a security. And there are others that meet that criteria as well, but there's a very large percentage of them that do seem to meet the definition of securities. And so they're kind of right now in kind of a regulatory arbitrage period where VCs can get to market quicker. They can get to exit liquidity quicker because they're kind of going around securities laws. And I think regulators are maybe not the quickest, but when that gets big enough, they start to realize it. And so I think 2022 could be the year of regulatory kind of crackdown on some of those. So overall, I'd just be careful of what I own, even though I'm not, for example, I'm not selling my Bitcoin, and I still think stablecoin, the market cap of stablecoins is going to keep going up dramatically. In my view, I think that's probably structural, and so I think that it could be very project specific what we see in 2022.
Yeah, one of the key things that I look at is the 4-year Bitcoin cycle and the stock to flow model, and what it basically says is that if history repeats, then next year is the time we're going to get this cycle top and also a big potential crypto winter. So what are your thoughts on a potential cycle top? and crypto winter and navigating that for investors?
So I think it's a decent possibility. One thing so a lot of people have been following the stock to flow ratio, and one thing in markets, if everybody's kind of following the same thing, it's almost guaranteed not to happen, right? It's either, and I was like, I don't even know, it could happen where everybody follows it and wants to sell at the same time, and then it just doubles from there, right? It could overshoot to the bullish side because everybody's like, oh, I gotta get out now because stock to flow says so. On the other hand, if everybody's expecting it to go up to a certain number and they're buying with that in mind, it might never get to that in that year because everybody was expecting it to and already kind of piled into that. And when it starts to not materialize, they get out, right? So markets have a way of kind of messing with the consensus. And so really it's about demand. We already know Bitcoin's supply cycle. The question, well, what we don't know is demand, right? And that can be, especially now that it's big enough, institutional demand matters a great deal. And so it's very tied into the macro conditions. And so overall, I would say that most indicators, on-chain indicators, did not get as bullish as 2017 or 2013. So we've not really had that huge blow off top. And so I'm not really in the camp that we're already in the crypto winter, for example. I do think we probably have more in the tank. I don't know if it's going to happen in 2022, 2023. One thing I would caution is that as the halving, basically as new supply starts representing a smaller percentage of Bitcoin's market cap, I think the halving is going to become less important over time. So I think the prior ones were all super important, and it was part of my thesis for investing back in spring of 2020. But I think that future halvings might be less important, both for bull side and bear side. And so basically that there's just less supply coming in from that. I think the big cycle to watch will be the holder distribution cycle. So if you look at say supply not moved on chain for over a year, or you can even narrow it to certain bands, like not moved for a year or two, not moved between 1 and 3 years, not moved between 3 and 5 years. There tends to be this distribution cycle where people buy in, then they have diamond hands, and they just they hold for a few years. Bitcoin goes up 5x, 10x, in a very volatile way the whole time, and then some of those have life-changing gains at that point. Bitcoin's like half of their portfolio now, and so they start distributing into that strength when basically they've kind of taken a lot of supply off the market. They've kind of contributed to the next cycle happening. More people come in, and then they sell into that strength, and you kind of get that distribution cycle. So I think that's going to be probably a key cycle to watch going forward, maybe more so than halvings, even though historically that's been tied to halvings. So you kind of had that go together. Halvings kind of served as a catalyst to go along with that distribution cycle, and I think that signal could deteriorate a little bit, and really kind of focusing on that distribution cycle makes sense.
And as everyone loves a good price target, how high do you think Bitcoin can go next year?
So I mean, it's tricky. I think it's got 100,000 in it. Again, I don't know if it's gonna be 2022, 2023. I try to avoid price targets of Bitcoin because it can just blow past them, right, in ways that are shocking. And so when I invested in April 2020, and then I wrote an article on it in June, for example, I kind of referenced the 30 to 50,000 range as a target I was looking for, but then pointed out 100K would in no way be shocking. And I was asked about it in say November 2020 when it was what was it, like 300 billion, and my view was that I think we're going to $1 trillion market cap, and so we hit that target. Now a couple times in 2021 when I was asked about it, I said I wouldn't be surprised to see 100K by year end or 2022. We obviously we still have a couple days left in the year, but that seems likely off the table. So I think we're 100K is still a target that I expect to reach eventually, but I try not to be too, it's guessing if I try to guess when it's going to happen, especially because Bitcoin is now tied into the broader macro space. So again, neither hitting 100K nor not hitting it in 2022 would be surprising, but I'd be surprised if we don't get there in 2022, 2023, 2024.
And how about Ethereum? So Ethereum is actually my largest crypto position. I know Raoul Pal is a big fan of Ethereum as well. So have you got any thoughts or analysis or price targets for Ethereum?
No specific price targets, but it is a market I've been following. So I've had some technical concerns with it, but I've also been tactically bullish on it. So it's something I cover approximately once a month in my research service. And the thing I'm watching is the Ethereum lockup contract. And so, they launched the Beacon chain about a year ago, and they're doing like, that staking contract, and that's one directional. Once you lock in coins, they're there until either something changes or until the merge happens. And so one thing I've been looking at is that Bitcoin's coming off of exchanges pretty rapidly, but Ethereum's coming off exchanges even a little bit more rapidly, partly because it's going into that contract. And so basically you have a liquid supply forming. And so as long as that persists, that's a pretty strong bullish variable. I mean, there's over 8 million ETH in that contract. I think we're getting close to 9. I haven't checked in maybe a couple weeks. And so overall, that's a bullish catalyst. I think that once that gets merged and unlocked, that could be a liquidity event that, some of those coins have pretty sizable profits, and some people might want to take profits off the table. So I'd be more uncertain after the merge. Ironically, it could be one of those sell the news events where a lot of anticipation builds up to it, and then maybe that's kind of a catalyst to cool off for a period of time. I don't really have a strong view. Another challenge that Ethereum is facing is that some of the newer smart contract platforms, the more centralized ones, are some of the DeFi and some of the other things are kind of a little bit spilling off onto those other ones because you have that scaling challenges, fee challenges, and so I don't really have a strong view yet on how that's going to shake out between Ethereum and some of its competitors.
So I don't know if you follow Michael Burry from the film The Big Short on Twitter, but he recently has been very vocal saying everything is insanely overvalued. And then we have people like Cathie Wood saying she sees exponential growth coming in the markets over the coming years. So who is right?
So I would say somewhere in the middle. I think one of the biggest challenges with the growth camp, let's say the Cathie Woods camp, is that a couple things. One is we've had this kind of exponential growth from Moore's law, right? So semiconductors keep getting more and more efficient, and then software has absolutely blossomed for decades. The internet, and then mobile internet, and then all the applications we built, and so that's been a very exponential area of growth. And I think it's a mistake when people apply that logic to hardware, especially coming from an engineering background. I just know there's so many more constraints for things in the real world. And an example I like to point out is that the fastest passenger jet was built in 1969. And we still haven't built a faster one, right? So we're 50 years later. People back then thought by now we would look like the Jetsons, and we're literally we can't do it with what they did back then. The fastest manned military jet was the Blackbird. That was also like 50 years ago, 60 years ago. I forget the exact date. We United States went through a period where we stopped the shuttle program but we delayed the next one. And so we had a 9-year period where we had to pay the Russians to bring American astronauts into space for the International Space Station because we couldn't really do it. And so hardware and things like that tend to not be as exponential as people suspect. I'm also watching the commodity shortages, kind of the structural shortages as it relates to copper, nickel, even oil and gas to some extent, compared to the estimates that they're going to be using in, say, 2030. And so I think we're going to be running into some, commodity constraints along the way to some of those visions of the future. And so I think that's a challenge. Also, I think a lot, especially earlier this year, a lot of like the ARK kind of Cathie Wood type of investments were very, very expensive. She had tremendous performance, partly because they went up very, very high, both in terms of growth, but also valuation on that growth. And so this year we've seen a big cooling off of valuation, even though ironically they're still high compared to traditional valuation metrics. So they're still pricing in a tremendous amount of growth, even though it's perhaps less bubbly than it was before. So actually, some of those names are perhaps more attractive now. I think some of the ARK growth stocks could do pretty well next year or 2 years. So I share some views with her, but I'm a lot more cautious about things that apply to hardware. And when it comes to Burry, I do think that most assets are bubble-like. I do think that the S&P 500 is unlikely to have great returns over, say, the next 10 years. I think some of the Nasdaq stocks, again, I think they're very, very expensive. I think bonds are overvalued. It kind of goes into the whole cash is trash thing. I think basically bonds, their yields are below the inflation rate. I think that if you hold bonds for the next 10 years, you're not likely to do very well in terms of purchasing power terms. Real estate in many countries is very, very expensive. In the US, it's less of a bubble than elsewhere, perhaps, but it's still expensive. And so I do think that there is, kind of an idea of an everything bubble. I think also the meme stocks and some of the cryptos have been very bubble-like, and that they're pro. In any given crypto cycle, 99% of that stuff ends up not really making it to the next cycle, right? It's kind of this: we throw everything at the wall and see what sticks, and there's only a small percentage of things that stick. So I think there will be things that 5 years from now are far, far more valuable than they are now. But I think a lot of them will likely not be. And so the areas that I would say are not bubbles are things like healthcare stocks, again, basically some of the value stocks, but specifically value sectors that are not being heavily disrupted, things that are just kind of cheap and not being heavily disrupted, and they just be kind of not exciting, right? So I think that that's the stuff that could kind of grind out better returns over a 5 to 10 year period compared to what people think. Whereas some of the really exciting stuff I think could stagnate. Now, I think that there's still exciting stuff, like whether it's Bitcoin or whether it's certain other things in the digital asset ecosystem. I still think they're going to do very well over a 10-year period, most likely. But I do think we're entering a period where people have to be pretty selective with what they own.
So when it comes to market crashes, how likely do you think it's going to be that there'll be a big crash in financial markets next year? And also, how do you prepare for them?
So the chance of it is higher than 2021, but it still wouldn't be my base case. I mean, my base case would be kind of choppy consolidation. I don't know if we're going to go to higher highs or if we're going to, just kind of stagnate. We could have a drawdown. Basically, when you have such a strong year, and then you have a pullback of fiscal monetary support, that can put some pressure on markets. And so a crash would not be my base case, but weaker market conditions would be. The ways to protect against it are to own some cash or bonds as a non-zero position so they can rebalance into the weakness of things you want to own, or to be long volatility, or to have other specific hedges, like some basically some puts or some long volatility plays that basically pay off if you get that downward volatility, that you can then use those gains to rebalance into, again, some of the assets you actually want to own. And so I think overall it is a time to be, somewhat defensive, which doesn't mean get out of everything that you want to own, but it means basically expect that it could happen so that you're not shocked if it happens and that you're ready to take advantage of it if it happens.
Yeah, it feels to me like the Fed's a bit stuck because they can't raise interest rates too much without crashing the market, but then they can't keep printing money now that inflation's at a 40-year high. So if there is a crash, what can or will the Fed be able to do?
So it would partially depend on what inflation is doing. If you see inflation maybe still hot, but it's maybe cooling off by that point, so it's a lower headline CPI or PCE than it is now, they could have some ammunition to come in and maybe do some more quantitative easing, for example. They have other programs in place too. They have repo, they have reverse repo. They could potentially reliquify the corporate market, the corporate bond market. So there are tools they can do. I think the bigger tools to look at, though, are fiscal policy. So people often, I think, assign too much power to the Fed, whereas a lot of what can drive markets and inflation and things like that is fiscal policy. So I think watching Congress, U.S. Congress, to see whether or not they pass some version of the Build Back Better plan. Right now, that's kind of been in limbo, right, because they had trouble getting votes in the Senate. But there are parts of that that, if passed, it would expand the money supply. It probably would increase nominal GDP, but also potentially increase inflation. So there's trade-offs there, and it's important, I think, to watch from a macro perspective. We're also seeing that for 2021. China was kind of the oddball compared to the rest of the world because the rest of the world was still very, very loose, whereas they were tightening conditions. So they had a declining credit impulse. They were cracking down on their tech companies. They were, purposely trying to deflate some of their real estate bubble because China's got this huge real estate bubble, very leveraged. Whereas that seems like it's bottoming out. If you look at the Chinese credit impulse, it's kind of showing signs of bottoming out. If you also look at, politically, they have their 2022 National Congress, which is their every 5-year kind of reappointment of leaders. So it's kind of a politically sensitive year for them. They wouldn't want, very tough kind of conditions during that type of, in the lead up to that event. So I think 2022, you could see China potentially holding up markets to some extent as well, kind of reinflating some of the globe. So I think I would look more towards U.S. fiscal policy, European fiscal policy, and Chinese overall monetary and fiscal policy compared to just looking at the Fed.
And finally, could you tell people a bit about the service that you offer and where people can find out more about Lyn Alden?
So I'm at lynalden.com, and I'm also on Twitter at Lyn Alden Contact. And I have a free newsletter, comes out every 6 weeks. It's pretty popular. I do public articles, and then also I have a low-cost research service where I publish content every 2 weeks, which is kind of my most updated thoughts on what's happening for some of these types of markets.
Brilliant. Well, thanks for sharing your insights, and we'll chat again soon.
Thanks for having me. Happy to be here.